Have you ever wondered why some of the most brilliant people you know are an absolute disaster with money? We all know them. The surgeon with a seven-figure income who's drowning in debt, the lawyer with a prestigious job who's one bad month away from ruin. And on the flip side, we hear these incredible stories of ordinary people, janitors, secretaries, gas station attendants, who, with no formal financial training whatsoever, manage to accumulate fortunes. How is this possible? It's a paradox that sits at the very heart of modern life. We're taught to think of finance as a hard science, like physics or chemistry, a world of spreadsheets, formulas, and data where the smartest people with the best information should, logically, come out on top. Yet time and time again, reality proves this assumption spectacularly wrong. We see intelligence and success in one field have almost no correlation with financial success. It's as if the rules of logic simply break down when a dollar sign is involved. This isn't just an occasional anomaly. It's a fundamental pattern of human existence. It's a puzzle that haunts so many of us, making us feel like we're missing some crucial piece of information, some secret that others have figured out. This very question became an obsession for a writer named Morgan Housel. For years, as a financial journalist and partner at a venture capital firm, he sat at the intersection of money and human stories, and he saw this paradox play out every single day. He realized that we don't make financial decisions on a spreadsheet. We make them at the dinner table, in a hospital room, in a moment of panic, or a fit of ego. He understood that to solve this puzzle, we had to stop looking at charts and start looking in the mirror. His journey wasn't about finding a new investment formula. It was about uncovering the deep, timeless truths of human behavior that truly govern our financial lives. To truly grasp the power of Housel's discoveries, we first have to immerse ourselves in the world as he saw it, a world that operated on a fundamentally flawed premise. For decades, the entire financial industry was built on a single, powerful idea: that money was a math problem. If you could just build a better model, gather more data, or create a more sophisticated algorithm, you would win. The people who made the most were simply the ones who were the smartest, the best educated, and had access to the most powerful tools. It was a clean, logical, and deeply reassuring worldview. But from his unique vantage point, Housel saw the cracks in this foundation everywhere he looked. He saw brilliant tech founders who could build world-changing products but couldn't manage their own spending. He saw hedge fund managers with PhDs in physics who would lose their entire funds and their clients' life savings because they were driven by greed and a refusal to admit they were wrong. The evidence was overwhelming. The traditional model was broken. It was missing the most important, most volatile, and most powerful variable in the entire equation: human psychology. The ultimate proof of this, the story that became a cornerstone of his investigation, was a tale of two men, Ronald Read and Richard Fuscone. On the surface, these two individuals could not have been more different. Richard Fuscone was the epitome of financial success. Harvard educated, an MBA from the University of Chicago, he climbed the ranks to become a top executive at Merrill Lynch. He was the kind of person you'd expect to be a master of money. He lived in a lavish 18,000 square foot mansion with 2 swimming pools, 2 elevators, and a monthly maintenance bill that was more than most people's salaries. He had every advantage imaginable. Then there was Ronald Read. Ronald was a janitor in Vermont. He fixed cars at a gas station for 25 years and swept floors at a JCPenney for 17. He had no formal financial education, no fancy degrees, and no access to the sophisticated tools of Wall Street. By all traditional metrics of success, he was at the bottom of the financial ladder. Yet, when the 2008 financial crisis hit, Richard Fuscone's world imploded. The heavy leverage he used to finance his extravagant lifestyle backfired, and he was wiped out, forced to declare bankruptcy. Around the same time, Ronald Read passed away at the age of 92. When his will was read, this humble janitor, a man no one would have ever suspected of being wealthy, left over $8 million to his local hospital and library. The world was stunned. How could this possibly happen? How could the Harvard MBA go broke, while the small-town janitor became a multi-millionaire philanthropist? This wasn't just a quirky anecdote. For Housel, it was a smoking gun. It was definitive proof that financial outcomes had little to do with intelligence, education, or even sophistication. It was about something else entirely. It was about behavior. And this realization launched him on a quest to understand the hidden psychological forces that truly determine whether we build lasting wealth or end up with nothing. The stakes couldn't be higher because the story of Ronald and Richard proves that our entire financial future depends not on what we know, but on how we act. The first major breakthrough in Housel's investigation came from a profoundly simple yet revolutionary idea. He realized that to understand why people do seemingly irrational things with money, you have to stop judging them from your own point of view and instead try to understand the world from theirs. This led to his first core principle: no one is crazy. Your personal experiences with money, particularly in your formative years, shape about 80% of how you believe the financial world works. What seems like a terrible decision to you might feel perfectly logical to someone else, based on the lessons life has taught them. Housel illustrates this with a powerful example: the lottery. From a purely mathematical perspective, buying lottery tickets is a fool's game. The odds are astronomically low, and economists often call it a tax on the poor and uneducated. We look at people in low-income brackets spending hundreds of dollars a year on tickets and think, that's crazy. If they just invested that money, they'd be so much better off. But now, let's apply the no one's crazy lens. For someone with a comfortable salary and a 401k, the path to a life-changing sum of money involves saving, investing, getting a promotion. It's a slow, steady, and plausible climb. But for someone earning minimum wage, someone who can't even afford a $400 emergency, that path doesn't feel real. The gap between their reality and financial freedom is an impassable chasm. For them, a $2 lottery ticket isn't a financial calculation. It's the purchase of a dream. It's the only tangible access they have to the kind of hope that wealthier people take for granted. In their world, given their options, it makes a certain kind of emotional sense, even if it makes no mathematical sense. This principle extends to everything. Think about people's attitudes towards the stock market. Someone whose parents lost everything in the Great Depression will carry a deep-seated fear of stocks that a millennial who only saw the bull market of the 2010s can never truly comprehend. Their gut feelings or instinct about risk were forged in entirely different fires. One sees the market as a casino designed to steal your money. The other sees it as a wealth-generating machine. Neither is crazy. They are both just products of their own unique histories. This single idea shatters the foundation of traditional finance. It tells us that there is no single, universally correct answer for how to invest or spend. We are all playing a slightly different game on a slightly different field, with a different set of rules that only we can see. The reason the brilliant surgeon gets into debt isn't because he's bad at math. It's because his personal history might have taught him that the primary purpose of money is to signal status and success, a belief that drives him to spend every dollar he earns. The reason the janitor becomes wealthy isn't because he's a secret genius. It's because his background might have instilled in him a profound sense of frugality and a deep-seated fear of debt. We are not irrational. We are just historically informed. And until we understand our own personal money story and develop empathy for the stories of others, we'll continue to be baffled by their choices, and more importantly, blinded to the biases that drive our own. Understanding that our financial behaviors are shaped by our unique personal histories was a monumental step. It explained why we act the way we do, but it didn't fully explain how someone like Ronald Read actually built his $8 million fortune. Frugality alone doesn't create that kind of wealth. This led Housel to a deeper, more complicated truth, a second principle that moves from psychology to mechanics. He discovered that the most powerful force in finance isn't intelligence or finding the highest returns. It's something far more subtle and far more crucial: staying in the game long enough for compounding to work its magic. The ultimate financial skill isn't being brilliant. It's being unbreakable. To illustrate this, he points to the most famous investor of all time, Warren Buffett. We mythologize Buffett as a stock-picking genius, a man who can find value where no one else can. And while he is a phenomenal investor, Housel argues that this focus misses the real secret to his success. The key isn't just that he's been a great investor. It's that he's been a great investor for over 75 years. He started when he was 10 years old. The math is staggering. Buffett's current net worth is north of $100 billion, But 99% of that wealth was earned after his 50th birthday. A full 97% came after he qualified for Social Security. His real skill wasn't just earning high returns. It was earning pretty good returns that he could sustain uninterrupted for an entire human lifetime. If he had started investing at 30 and retired at 60, like a normal person, even with his incredible skill, you would have never heard his name. His fortune wasn't built on a few brilliant moves. It was built on a foundation of time. The power of this principle is most clear when you see what happens when it's broken. Housel introduces us to Rick Guerin, a lesser-known partner of Buffett and Charlie Munger in their early days. By all accounts, Guerin was just as smart as them, perhaps even more aggressive and quicker to spot opportunities. But he had a fatal flaw. He was in a hurry. During the brutal market crash of 1973 to 74, Guerin was heavily leveraged. He had borrowed money to amplify his returns. When the market plunged, he got a margin call. He was forced to sell his shares of Berkshire Hathaway back to Buffett for a pittance, less than $40 a share. He was a genius, but he got wiped out. He wasn't unbreakable. He couldn't stay in the game, and he missed out on the decades of compounding that followed. This is the crucial complication. Our psychology, our impatience, our desire for quick results, the very things explained by the no one's crazy principle, are what make us fragile. We take on too much debt. We don't save enough for emergencies. We chase hot stocks, all in an effort to speed up the process. This leaves us vulnerable. A single unexpected event, a job loss, a market crash, a medical emergency, can force us out of the game entirely, just like Rick Guerin. Ronald Red, the janitor, understood this intuitively. He wasn't looking for 10-bagger stocks. He was buying solid, blue-chip companies, and then he just waited. For decades, he lived through market crashes, recessions, and wars. But because he had no debt and lived frugally, he was never forced to sell. He was unbreakable. He stayed in the game. He let the quiet, inexorable magic of compounding do its work, year after year, decade after decade. This is a deeper truth. Good investing isn't about earning the highest returns, because the highest returns often require taking on terrifying risks. It's about earning pretty good returns that you can stick with for the longest period of time. It's not about swinging for the fences. It's about ensuring you never, ever strike out. So now we have two powerful, seemingly separate ideas. First, that our financial worldview is shaped by our unique personal history. And second, that the mechanical key to wealth is not genius, but survivability and the long-term magic of compounding. But the true genius of Housel's work is how he weaves these two threads together into a single, unifying aha moment. He reveals that the reason we so often fail at the second principle, staying in the game, is a direct consequence of first, our flawed psychology. Specifically, it comes down to a fundamental and tragic confusion between two words, being rich and being wealthy. We think of the same thing, but they are, in fact, polar opposites. Being rich, Housel explains, is a current income. It's visible. It's the $100,000 car, the multi-million-dollar house, the designer watch. It's money that you have spent to signal to other people that you have money. It's a loud public display. Wealth, on the other hand, is hidden. Wealth is the money you haven't spent. It's the assets in your brokerage account, the stocks, the bonds, the real estate that haven't been converted into shiny objects yet. Rich is a flow of cash. Wealth is a stock of assets. Wealth is financial freedom. It is optionality. It's the ability to wake up in the morning and do whatever you want with your day. It is quiet, unseen, and internal. This is a grand trap that ensnares so many of us. Our psychology, our deeply ingrained need for social comparison, makes us fixate on the visible signals of being rich. When we see someone driving a Ferrari, our first thought isn't, wow, that person has deployed a significant portion of their assets into a depreciating vehicle. Our thought is, wow, that person is successful. We use them as a benchmark. And so the impulse to keep up, to show the world that we too are successful, becomes overwhelming. We start making decisions designed to increase our visible richness. We buy the bigger house, lease a fancier car, and take the more extravagant vacations, often financing it with debt. the very leverage that made Richard Fuscone and Rick Guerin so fragile. This desire to signal richness is precisely what prevents us from building wealth. Every dollar you spend on a status symbol is a dollar that is not compounding for you. It's a dollar that is not working to buy your future freedom. This is the grand synthesis. The reason it's so hard to be unbreakable and stay in the game is because the modern world is a constant assault on our ego, tempting us to trade our future wealth for present-day status. The unifying idea is this. The single greatest obstacle to building wealth is the social pressure to prove to other people that you have money. Ronald Read became wealthy because he was utterly indifferent to what other people thought of him. He derived no satisfaction from showing off. Richard Fuscone went broke because his entire life was a performance of being rich, a performance that required him to be constantly on the edge of financial ruin. The ultimate financial skill, then, is not picking stocks or timing the market. It is the psychological skill of getting the goalpost to stop moving. It is defining what enough means for you, independent of what others are doing, so you can escape the rat race of comparison and allow your unseen wealth to quietly grow. We began this journey with a simple question: why do smart people struggle with money? And what we discovered is that the answer has almost nothing to do with how smart you are. We learned that our financial instincts are forged in the unique fire of our personal history, making our behaviors rational to us, even if they look crazy to others. We then uncover the mechanical engine of wealth. Not brilliant, risky bets, but an unbreakable commitment to surviving and letting your money compound for as long as possible. And finally, we saw the profound connection between the two, how our psychological need to appear rich is the very thing that sabotages our ability to become wealthy. It's the quiet, patient, and often invisible journey that builds true, lasting financial freedom. So, what does this mean for you right now? It means you can stop beating yourself up for not being a financial genius. The blueprint for success isn't about outsmarting the market. It's about outmastering yourself. First, take the time to understand your own money story. Acknowledge the biases and beliefs you inherited from your upbringing. This self-awareness is your first line of defense against destructive behaviors. Second, shift your entire financial focus from maximizing returns to maximizing your staying power. Build an emergency fund. Avoid consumer debt like the plague. Create a buffer in your financial life so that the inevitable shocks of the world can't knock you out of the game. Prioritize survival above all else. And third, and most importantly, define what enough means for you. True wealth isn't a number in an account. It's control over your time. It's the ability to choose your work, to spend time with your family, to pursue your passions. Once you define that goal, you can tune out the noise of social comparison and focus on what truly matters. Understanding these principles is the first, crucial step, but true change comes from living them. It's a journey of trading a life of stressful signaling for one of quiet confidence and genuine freedom. If you're ready to continue on that path, to master not just your finances, but the psychology that drives them, then subscribe and become part of a community that values wisdom over wealth displays. It's a commitment to a future where you control your money, instead of letting your money control you. Because the greatest dividend that money pays is the ability to wake up every morning and say, I can do whatever I want today.